Earnings management refers to the practice of deliberately manipulating a company's financial statements to either overstate or understate its financial performance. In this video, we'll examine the various forms of earnings management and their impact on stakeholders and society. Is earnings management the same as earnings manipulation? Many people differ in their opinion. Some believe it depends on intent. But earnings management is not necessarily the result of intentional fraud, but nonetheless, if the end result is that it distorts the application of GAAP, then it brings the quality of the earnings in question. One aggressive interpretation of GAAP leads to another until the quality of the financial information is in doubt. Earnings manipulation can take various forms. Here's some of them. Income smoothing occurs when companies artificially even out their earnings over several reporting periods by shifting revenues and expenses between periods. This makes it appear as though the company's financial performance is stable and predictable when it might be inherently volatile. In cases of big bath accounting, a company anticipates poor future performance, and it might intentionally overstate its losses or expenses in the current period, creating a big bath of poor performance. This allows the company to show significant improvements in future periods, making it look like a strong recovery is happening. As part of channel stuffing, companies might push excessive amounts of products onto distributors or customers at the end of a reporting period to recognize higher sales and profits. This can lead to an unsustainable boost in revenue. Income shifting occurs when multinational corporations may shift income between different subsidiaries or regions to minimize taxes or regulatory burdens. Timing of expense recognition happens when companies delay recognizing certain expenses or accelerate revenue recognition to make their financial performance appear better than it is. Our textbook mentions a survey done by Bruns and Merchant in 1990 of how managers view the ethics of earnings management. They found that managers had very differing views of whether earnings management was earnings manipulation. For instance, they found that in general, the respondents thought that manipulation of earnings via operating decisions, like for instance, delaying making needed repairs to a subsequent year, was more ethically acceptable than manipulation of accounting methods. What impacts does earnings manipulation have? Let's look at that next. Earnings management misleads investors, creditors, analysts, and other stakeholders who rely on financial statements to make decisions. When financial statements do not accurately represent a company's financial position and performance, stakeholders cannot make informed choices. It erodes trust in financial markets and the broader business community. When investors believe that financial statements can be manipulated, they may be less willing to invest in or lend to companies. Earnings manipulation distorts market efficiency because accurate financial reporting is crucial for market efficiency. Earnings management distorts market prices and can lead to misallocation of resources and investment decisions based on false information. Earnings management can cross legal boundaries and violate securities laws. Companies and individuals engaging in fraudulent earnings management can face legal action, fines, and imprisonment. While earnings management might provide short-term benefits, it can harm a company in the long run. Once manipulation is uncovered or when the effects wear off, the company may face serious financial difficulties or a loss of credibility. In summary, earnings management involves manipulating financial statements to create a false perception of a company's financial health. This practice is unethical because it undermines trust, distorts market efficiency, and can have serious legal and financial consequences for the company and its stakeholders. It is essential for financial reporting to be transparent, accurate, and reliable to maintain the integrity of financial markets and the broader economy.